For our next panel, we're going to talk about deal making in 2022. We're coming off a record year for mergers and acquisitions where technology and industrial sectors were the largest contributors at 26% and about 20% respectively. And sponsors played an outsized role, participating in about 40% of U.S. M&A activity. With increased market volatility, rising interest rates, surging inflation, and economic uncertainty are the tides shifting. Our panelists will explore how the macroeconomic backdrop and the changing regulatory regime are impacting deal making. I'd like to bring out our panelists. We have moderator Michal Katz, Head of Investment and Corporate Banking at Mizuho Americas, Laurence Goldberg, Managing Director of ONEX, Arlen Shenkman, the CFO and EVP of Citrix, and Laura Turano, M&A partner at Weiss.
All right. Good morning, everyone. My name is Michal Katz. It's great to see everyone here today. Before I introduce my esteemed colleagues on the panel with me to discuss the state of the M&A markets, I want to set the stage as to what we have seen. So through the end of 21, global M&A volumes reached all-time records of $5.9 trillion, with the U.S. constituting 45% of that at $2.6 trillion. That's up 64% for global and 82% for U.S. activity compared to 2020, where we all saw the impact in M&A activity due to the onset of the pandemic. Corporate balance sheets are incredibly healthy. The S&P 500 has amassed about $2 trillion of cash. PE fundraising has really been unabated, and private equity firms are now sitting on $2.3 trillion of dry powder, looking for to deploy it. 600 SPACs that raise $160 billion are looking for M&A targets. And while the markets have been spooked by the crisis we're seeing in Ukraine and the prospect of increasing rates, the cost of funding remains low. So all of these dynamics should really set the stage for a continued robust M&A activity in 2022. But with the rising inflation, the increasing rate, the geopolitical instability, and I would say the regulatory flex out of DC, what we're going to be exploring today is whether we're seeing a shift in M&A activity. And so with me today, to my left is Laurence Goldberg, who is a managing director at ONEX Partners, where he's responsible for technology investments with a focus on software. And prior to that, Laurence has had an incredibly successful career as an investment banker at Barclays and Lehman and Credit Suisse before that. Next to him is Laura Turano, who is in the corporate department of Weiss, where she's a partner in the M&A group and responsible for both private and public M&A, working on incredibly complex transactions, JVs, and what have you, including shareholder activism and defense. So incredibly excited to hear her insights, and she's also a Miami alum. And next to Laura is Arlen Shenkman, who is the EVP and CFO of Fort Lauderdale-based Citrix, also a Miami alum, University of Miami Law School alum, I should say. Prior to his role as a CFO at Citrix, Arlen was head of M&A and other senior roles at SAP, where he was leading several of the transformational transactions at SAP, including companies that many are familiar with, be it Concur, SuccessFactors, Ariba, and what have you. So I'm incredibly excited to hear their insights. So with that, let's get the conversation started and maybe talk through some of the trends and dynamics that we're seeing. So to begin the conversation, Laurence, both as an investor and a former investment banker for over 20 years, 2021 was quite different from 2020. In the first half of 20, M&A activity pretty much came to a halt. only to come back with a vengeance in the second half of 2020, and that continued into 2021. So the question is, what were some of the drivers of the M&A activity in 2021? And do you think that those have changed or have some stayed the same as we're thinking about this year?
Well, first, thank you, Michal, for inviting me to speak on the panel. As Michal may, I don't remember if she said or left out, but we used to work together at Lehman Barclays, and it's great to see you and to be here. So you quoted some of the M&A volumes. I know the buyout volumes were in 21. There was over $1 trillion in buyouts, which was double 20, and it was an all-time high, beating 2006, 2007 levels. Why did that happen? It's a few reasons. One, confidence. People came out of the pandemic with real confidence, and it's sort of counterintuitive, but when stock prices are going up and valuations are rising, people are more able to buy. They have the confidence to buy it. You probably should be buying when stock prices are down, but it's easier to buy when you feel confident too. You mentioned the rates, which were low, and all of the capital. But actually, the biggest thing that drove the volumes, from my point of view, and as a tech investor, I think about productivity enhancements all of the time, was the productivity change in deal making. So when I started in deal making 30 years ago, there weren't cell phones and emails and the internet, and you could work on a deal at a time. Maybe you could do two. Obviously, that's changed over the years, but during COVID, Zoom diligence and Zoom interactions just became accepted, and it was a step change in productivity. So whereas before it was about travel schedules, when could everyone get together and meet? Now, if you have a diligence question, you can get the 4 experts from around the world on the phone and get the answer within like a couple of hours. And that has really changed, and that's not going to go backwards. So I think the pace of deals and the ability to do multiple deals at the same time has really changed. And I expect levels will stay elevated. I know they're down. We're not going to do, obviously with all the economic issues and interest rates going up and the political uncertainty, I think M&A is going to be down this year, but I expect going forward, deal making will continue to be fairly higher than it had been historically.
Maybe to follow up on the comment you made around confidence, Arlen, maybe turn that to you. How do you see the current geopolitical instability and the economic backdrop, which is now uncertain to some degree? Folks are questioning GDP growth. How is that impacting the dialogue in the boardroom and the appetite to pursue M&A?
I think there's certainly more reticence. As Laurence highlighted, I think all of us tend to focus more on risk, and when we're confident, we focus less on risk. And I think in today's environment, particularly with the geopolitical environment and what's happening in Europe and Russia, with rising interest rates, I think there's a lot more reticence to go pursue deals, for strategics at least at this point, than there would have been, in the middle of 21. As Laurence said, people got really comfortable really fast, that you didn't need to sit down and have dinner with the CEO to buy a company. You could actually just do it over Zoom, which is a huge step change for people. But I think the geopolitical uncertainty certainly slows down strategic deal making.
And Laura, last year, mega deals, and we're defining those as deals 10 billion plus, constituted a little bit north of 20%. The bulk was still kind of called 50+% was transaction in the 1 to 10 billion. How do you see that changing in 22? Or maybe not?
Yeah, no, it's a good question, because I really think that is a big change. So I think the mega deals that are out there right now are a lot smaller, and that's driven by the fact that you just have such a terrible antitrust environment for big deals that you don't have that same confidence in the boardroom that this is the time to do it. And so I think while you'll continue to see a lot of M&A volume in this upcoming year, we're really going to have a shift from mega deals down to smaller deals, even smaller than the 1 billion rank, to kind of fill that space. And what would have been big deals are going to be shelved, and instead you'll have a company looking inward and thinking, should I be spinning off this business unit? What are other things just in terms of organic growth I should be doing instead of the mega deals.
So maybe switch gears a little bit to talk about valuation and investment strategies. So the Dow Jones Industrial Average and the S&P hit records in early January, and we've of course seen the volatility and the recent sell-off. The Dow is down 10% for the year, S&P down 12%, the NASDAQ getting even hit more than that, with down close to 20% for the year. So Laurence, you talked about PE having played an outsized role in M&A last year, but at the same time, you have SPACs looking for transactions. Corporates had incredible amount of confidence in pursuing deal in 2021. Maybe walk us through how you think about value creation and valuation, particularly in environments where valuations are somewhat stretched.
Yeah, as there are more capital in private equity as the other source of capital, the competition keeps getting steeper and steeper. And I think the way that we've tried to approach it is to be hyper focused and really hone in. So I'm, as Michal mentioned, I'm responsible for software investing in ONEX, which software is a huge, I think it's 40% of all of private equity. I'm only focused on a handful of themes and going really deep in those themes. So we will go out and meet every company that fits into our sector. If they're actionable, if they're not actionable, go super deep and figure out what we want to invest in or what we want to buy. And then when the time comes, we have the confidence to do it, because you have to pay a market clearing price, and you're paid to invest, so you want to make the best investment. So my view is that the way to sort of counteract that is to just know what you want to buy. I feel like when you find out something's for sale or there's an investment opportunity available, if you're deciding if you want to look at that or make that investment, you're not going to make the investment. You have to know. You may not ultimately get there on value, but you have to know you want to do it. That's sort of how we've dealt with that. And we've also bulked up at our firm, we've bulked up our value creation team as well, because any lever that you can pull and help an investment is important.
And maybe just for those in the audience, when you say value creation team, who are those, or what is that?
We have a variety of former executives, consultants that help our portfolios with sales and marketing, with technology, with HR, with all kinds of functions to try and generate the returns that we need to generate and make the companies better for our investors.
And that's a differentiator too, as you're searching for assets.
Yes, indeed.
Maybe following up on that, one of the things that we have seen in the private equity and alternatives space broadly is that the type of investments and maybe investment strategies have broadened from the traditional LBO, where you're looking to lever a company and then leverage the cash flows to either do a dividend recap and just keep on doing it again and again. And we're seeing private equity firms, investing in higher growth, less profitable names. We are seeing private equity and alternatives taking minority stakes, PIPEs, which are private investment in public entities, and also pairing up, not the traditional consortia per se, but for example, Citrix, where Arlen is still with, recently announced that it is getting acquired by a private equity firm that has paired up with a hedge fund. And so with all of those different, call it investment strategies, has the return model changed as you're thinking about investments?
We haven't, so we're more flexible. I think you have to be flexible, because if we're being hyper-focused and only focused on a couple things, there could be a company that we love that says we don't want to sell ourselves, but we want to sell a stake in ourselves. And so we view ourselves as active investors. We want a big enough position so that we can use our value creation opportunities and we can make a difference and be influential. But as values have gone higher, the leverage component of the IRR is less than in most tech opportunities. Growth is the biggest driver of IRR. So the leverage is important, but it's not what it used to be. So we've kept our return expectations the same. We underwrite to the same IRRs that we've always underwritten to. The makeup has changed a little bit, but we have become more flexible, and I think in terms of structure, as have most private equity firms.
It's really interesting, the growth lever versus the leverage lever. And Arlen, maybe I can turn this to you. You come at M&A from the corporate lens, having been in your role as CFO of Citrix, and I know you can't talk about that transaction, but maybe talk about the lens through which corporates are acquiring assets. Do you think that corporates are more or less competitive than the private equity and alternative buyouts? Maybe perhaps the reason for my question stems from the fact that you do have public shareholders. Like, walk us through that value creation from the corporate side.
I think years ago, if we go back 10 years, I think most people would say that a strategic can always pay more than a private equity firm. And always those synergies had this sense of, how does this fit in my portfolio? How does this fit with what I'm trying to achieve? How am I going to grow my business? And I think that that remains incredibly important, obviously, and a strategic really shouldn't be doing a deal unless it fits in their strategic vision and their portfolio and they bring synergy to it. I do think over the years, two things that have happened. I mean, one is that private equity has built its own portfolio of companies, which in some respects makes them quasi-strategic at times, depending on what's in the portfolio. And the second is that over the past probably 15 years, the strategic buyers have been much more reticent to leverage their balance sheet. And wherever that perspective is in the boardroom on what is a long-term cost of capital, what is my weighted average cost of capital, there's really become a disconnect between private equity and strategic buyers historically over a long period of time. And both of those have made private equity more competitive in terms of being able to offer premiums for assets.
Laura, maybe to kind of follow up on that, do you think boards are more cautious today in transacting, whether it be around premium paid for assets, ESG, or any other considerations that come into play?
Yeah, no, I think that they are. And I think the premium paid is a big piece right now because when you have the market dislocation you have, when I think this is a very simpleton way of viewing it, but when a new deal comes in the door and my client as buyer says, oh, we're really excited about this one, it's going to happen, we really think it's going to happen, we're going to pay a 30% premium, and you pull up the target's information on your Bloomberg screen and you're like, oh, and they're trading at a 52-week low. Like, doesn't really sound like a deal that's going to clear, but yes, we'll work really hard until that dies. And the same thing can happen where you're already on discussions, and we've been struggling through this for the last several weeks, where buyer and target were talking, and when they were talking, we were talking about a 30% premium deal because the target stock was at a normalized level, and now you're looking at it being a 90%, 100% premium in industries where that's not the premium people want to see, right? And so you have a board of directors on the buy side saying, I just don't want that headline. Investors are going to kill me for this, and really having a struggle moment over that. I think on ESG, it's a little bit less so. I think ESG is definitely more of a diligence focus. It definitely can be an opportunity for value. So, Microsoft Activision, if you didn't have the HR issues at Activision, I don't think that deal would have happened, right? But it's not as much of the driver for pause unless that's what is actually driving the deal completely, which can happen. Chevron, Reggie 2 weeks ago, which we worked on, is an example of that, of trying to have a renewables deal as an oil and gas company, but usually less so.
Or it could be a catalyst for transaction to the extent, which is what happened with Activision, or
Right.
to the extent you're looking to divest a carbon footprint or
Right.
actually buy a renewable. So it'd be a catalyst for.
Exactly.
So we have a variety of investors in the audience, I think hedge funds, money managers. So let's talk a little bit about shareholder activism. And Laura, why don't we start with you? After a period of maybe called a hiatus in activism during the 2020 period, activism is back. And maybe set the stage for us as to what you are seeing broadly? And
Definitely.
particularly as I'm thinking through, has their strategies changed? Has their playbooks changed?
Yeah, so it was definitely on hiatus during the beginning of COVID. And I think that there's two things that were causing that. I think people wanted to think it was sort of the humanitarian, how can you in the middle of a pandemic launch a proxy fight? But I think it was also just a confusion in the market. So you don't see activists coming in when they don't know where the bottom is, right? And if you rewind 2 years ago, that's when CNN was saying, S&P down 1 million, right? And who knows if Trump will close the markets? It's not when you're launching a proxy fight. So then this last year, return to normalcy, return to normal levels of activism. And then I think so far in 2022, we've seen the same thing. The big pieces I would highlight is you really still have, it's about 10% of activism that's at large cap companies. So size, again, not something that's going to protect you, right? You still have a risk. One of the activist situations we were involved in, Intel, huge company, doesn't mean that they're protected from activism. A lot of M&A focus. So that's what you're really seeing right now in the context. About 40% of activist attacks are something that's about either do M&A, so sell yourself, buy something, or opposing M&A. You have a deal, we don't like the deal. The other piece I would say in terms of context, and this is kind of late breaking last week, is you had Third Point come out against a de-SPAC company, say they were investing, say that they need to sell themselves because of all the things going on. And with all the companies out there that went through a de-SPAC and are kind of on shaky footing, I think that's what we're really going to see is more focus on those companies because they kind of have become this low-hanging fruit in the ecosystem. So I think that's the thing to really watch.
Would you say that campaigns have been successful, or maybe we should define for the audience, how do you define success?
Yeah, so it's funny, success is a very broad word, right? Because success, it's not even so much like winning in a proxy fight, right? Proxy fights are expensive and terrible experiences. So in a way, if you're a company and you're going through a proxy fight, even if you win at the end of the day, there was a loss there of the experience. And so as an activist, you win if you get, you may have announced that you wanted the whole control of the board, but you get one seat through a settlement. That's a win, right? You announce you're in a stock. When Third Point announced last week that they were in this de-SPAC company stock, it went up 40%. That's a win, right? Because when you do those things, you're attracting investors, you're showing when you make moves, people follow. So I think you do have that success, especially when it's so broadly defined.
So have corporates changed how they approach activists? Are they willing to drag out the fight? Are they ready to settle quicker?
Yeah,
have you seen a change in that?
I think so. I think statistically you see it in that most end in a settlement. And I think you also have, if we rewind 5 years ago or even farther back, the idea of having an activist on your board was just so terrible, people would immediately say, we're going to fight to the end of the earth. And I think with just the acceptance of that as an asset class, you have more of a view of success can be not having the activist himself or herself on the board, but if they nominate someone who is really an industry player, because activist nominees now are not people that you're finding on the street. They're people with real credentials, that could be a win as a company. And so you want to kind of get on with life. So I do think you're seeing that.
Thank you for that. And maybe kind of, Arlen, maybe you can comment on last month, Zendesk, which announced its acquisition of Momentive. And Momentive is the company that is behind SurveyMonkey, the online survey tool. So Zendesk shareholders voted against the transaction. So they scuttled the transaction. So when corporates are thinking about doing M&A, and even maybe perhaps before announcing an M&A, walk us through what can they do to manage through shareholders and shareholder support or shareholder activism?
Yeah, I think it has to start with communication with your shareholders and helping them understand where M&A fits in your capital allocation strategy, how you're thinking about growing your business, and why a deal fits in that vision and in that strategy. You mentioned Zendesk in that deal. I think there were a couple things going on there. I mean, one, I think most investors weren't totally understanding the strategy based upon how it was communicated. I think the second was it was a stock deal, and people have a lot of sensitivity to stock deals generally, but your shareholders again want to really understand why you're doing something. And then there were some optic issues in there. I think that it's really important that that management makes sure that there's no conflicts of interest and that they understand how they're communicating with one another and that there's a lot of objectivity. And there were concerns that activists and other shareholders had raised in those regards. So I think it's really incredibly important to be sensitive to certainly public company M&A when you're trying to grow your business, and frankly you're using other people's money when they're your shareholders and they want to understand why.
And not just activists.
Yes.
So Laura, earlier on you mentioned antitrust, the current antitrust environment, and I was trying to think of the word to describe the rhetoric coming out of DC. First I was going to use the word ardent, and I was thinking, okay, it's been outright hostile.
Yes.
And that's clearly has the, is clearly impacting deal activity when we've seen the likes of the Visa Plaid transaction, Lockheed Aerojet, the Aon Willis Towers transactions that have pretty much decided to walk away from the deal. Can you walk us through what is going on in the DOJ and the FTC right now, particularly around antitrust and antitrust approval?
Happy to, because it's truly, in my world, sort of the most important thing, which is that you have, and hostile is the right word, it's regulators who are the most hostile to deals that it's been in decades. And I think that when you really internalize that, they don't want big deals to happen. They don't even really want middle and small deals to happen because, and it's very politically charged. So I think you have the FTC and the DOJ not enforcing the laws, the antitrust laws that exist today, but really trying to push forward what they want the laws to be. And that's troubling because when you have that environment, what you end up having is uncertainty, right? And the opposite of what you want when you're doing a deal, which is conviction and exuberance. As soon as you put in this question mark of how long it will take and will it really happen, you've already scuttled a transaction, right? The real impact aren't the deals that you read in the newspaper as being terminated. They're the deals that never get there because a board is saying, I don't want to go through this, right? I think that what you're going to have too is when you actually do have companies that are willing to go through with a deal, really an increased focus on how long is this going to take and making sure they have enough time to get done and really taking a more aggressive stance towards the agencies of saying, I'm comfortable that this works under our current antitrust laws, and if you disagree with me, agency, we'll see you in court because that's what I'm going to do to get the deal through. Which again, that sort of see you in court is why so many companies end up making the decision, I don't want to deal with that, right? Let me focus on something else right now.
So what suggestions or recommendation do you have for clients that are looking to pursue a deal, just knowing that that is in the background?
Yeah. I think the most important part is doing your homework up front and as a buyer or as a seller and really understanding with your antitrust lawyer, what is the risk? How do they quantify that risk? And how do they think about it in the current environment? And really getting that work done first so am I dealing with a deal that actually doesn't have antitrust risk and so we're just talking about time to get through something that's annoying? Or is this a deal with real risk? And how can I combat that risk up front by saying, hey, government, I know this is the issue. I'm going to fix it, and so you should have no more issues with this deal. The other really big piece is understanding the international component. And so what we've seen the FTC and DOJ be really willing to do is look to the CMA in the UK, look at the European Commission, and have them be the bad guy and them be the ones to drag it out. And even if you have very little business in Europe or in other countries, really understanding what the timeline is for that so that your whole strategy isn't just US focused, but really takes into account that all these regulators could be working together to mess up your deal.
So I was just looking at sectors that were most active last year in M&A, and technology was at the top, industrials, and then FIG or energy, financial institutions or energy. Which sectors are most affected by the regulations?
I think the biggest is tech and healthcare, right? I think that's where you have to, big tech is bad, right? Big is bad. And so I think that's where you're most worried about. And then you also see the focus right now even on regional banks. So I think that the Biden directive identified all these industries, but anyone, even if you have low cost labor, right? Because it's beyond traditional ideas of antitrust harm and more into pushing the democratic agenda of environment, labor practices, and that can just cause your deal to take longer even if there's no real risk.
Thank you for that. Well, maybe I could ask you one last question on that topic before we move on. Do you think, and again, speculation, that a change in Congress with the midterm elections, would that change the overall dynamics?
I think it could help slightly, but I don't see a big difference. I think that I think that the Democrats will be under pressure in that situation, but I think that this is a real area of focus for the far left, and I think that you have to keep that coalition together. You have people who aren't on the left that are willing to let them kind of run rampant on this area. So I think that this is an issue for past just the midterms.
Thank you. So maybe just to hit on a number of different topics, not necessarily related to the above, but Laurence, you mentioned before that you at ONEX tend to dive deep into specific areas. Are there any themes or sectors that you're really passionate, excited about, and why?
Yeah, I would say one is our strong view that there will be much more software and technology used in K-12 schools in the United States. There's $700 billion a year spent on K-12 schools, and less than 2% is spent on technology, and that's just far behind most industries. And so we sort of spent a lot of time thinking about that a few years ago. We made two investments, a company called PowerSchool, which is the largest non-instructional software provider to K-12 schools, which we actually took public last year, and another one called Imagine Learning, which is the largest digital-first curriculum provider to K-12 schools. And what's happened during COVID, we thought there would be more tech use. During COVID, it acted sort of as a forcing function to get tech into schools. There was federal and state and local funding, and the number of students with access to a device went from 50-ish% to 90%. Broadband was upgraded. A lot of teachers have been reluctant to using learning management systems, and they were sort of forced to use them. And so we're already feeling a lot more tech usage. It's great that students are back in school, but teachers aren't saying, okay, now you're going to hand in the paper as opposed to uploading it. Like, that's changed, and we think that trend is going to continue. We're pretty excited about the opportunities in that area. The other thing I would just say is software. I feel very lucky to be in software. Cloud adoption, which is so persuasive, you'd think it was like, it's been happening for so long, but the fact that Amazon Web Services is $70 billion a year and still growing at 40% says we're still in the early innings of software adoption, and we have a long way to go. So there's lots of exciting opportunities we see in the coming years in software. 2%
adoption in education, that's kind of unbelievable. Maybe that's a question, Arlen, I want to touch on. You're in the tech sector as well. Digital transformation, touching every sector. How do you see that impacting deal making? Because we've seen talking about a lot of potential obstacles, whether it be antitrust or valuation, et cetera, but digital transformation is one that's talked about across every sector.
Yeah, and it's not going to stop. I mean, as Laurence said, cloud adoption, no matter what business you look at, there's always legacy technology. And so in some respects, when you look at enterprises or you look at schools or you look at healthcare, oftentimes we think of a digital transformation as, well, let's just move the whole landscape and we'll have a new system and we'll enable our technology. Reality is that it's actually multi-layered. And you don't remove an SAP system. You live with it and you build around it. You don't live with an Oracle system, the biggest enterprise systems. And the same is true with all forms of innovation. So, rarely does technology go away. Somebody here is going to get a fax at some point, I'm sure. The technology doesn't really go away. We continue to build on it. And ultimately, as we continue to innovate and we have more computing power and we have additional systems and we have more insights, we continue to innovate. And software has been a major driver of that. And digital transformation, I think, certainly in probably everyone's lifetime in this room will continue to build on what we've innovated with.
That makes sense. Laura, maybe touch upon a little bit around globalization, right? Last year, cross-border M&A accounted for about a third of the volume. I don't know if the world is getting smaller or getting more interconnected, particularly given some of the geopolitical backdrop. Like, what do you think first of all drove that cross-border activity? And do you see anything in the landscape that may be changing it going forward?
Yeah, so I think it's capital searching for opportunities, and I think it also goes to really how much easier those deals were to do in the last 2 years. So, all of my cross-border deals, they were done with no meetings together in any country. They were just done over Zoom. And so you were able to find these opportunities and really pursue them in a Zoom screen, only worried slightly about time differences in terms of who was doing what when. I think that there will be challenges just because on the antitrust piece, again, every place, it's not just a US issue, it's also where we're seeing regulators and those who are also worried about foreign direct investment, though that is challenging overall. But I think that the connectivity and the productivity is here to stay, and so you're going to continue to have more than you had in the past.
We have a couple of minutes left. I don't know if there are any questions from the audience. Well, I can continue going. Any hands up? Okay. Maybe the question is that, Arlen, I'll turn to you first. Having done both private as well as public transactions, are those easier or harder? I'll let Laura follow up on that.
Sometimes smaller private deals are harder than big public ones. I will say thematically, one of the more interesting things you see with deals is whether a deal is small or big, once it's announced, people assume it's done. And the reality is that a lot of the work is just beginning, and it's really keeping focus. And I think that sometimes actually bigger deals, when there's a significant amount of capital deployed, a mature management team, a solid set of products, there's more of a paradigm of how you integrate that or operate that or potentially build it into your portfolio as opposed to a smaller deal. So I think what's important is not to confuse the two because they're very different M&A. There are large strategic deals, there are mid-sized deals that are tuck-ins for companies, there's technology deals, and the most important thing I think is understanding in the M&A context what you're trying to achieve and where that fits in your portfolio so that you can appropriately focus on closing it, but also integrating it and operating the business in the right way.
The hard work begins. Laura, how about from actually execution and approvals and what have you?
Yeah, no, I agree completely. I think the small ones can be very hairy, and everything is a big issue because it's so small as a deal. And also agree that it's hard sometimes as an advisor to remember that once even the deal is closed, all you've done is deliver the baby, and now someone has to raise it, right? They need to do the integration and actually make whatever the business case is work and play out. So I think both just bring their own challenges.
And Laurence, maybe to finish the conversation, anything you're looking out for in 2022 as you're looking to deploy capital?
Nothing that as I said, I feel very fortunate to be in tech and in software, and it always feels like when you and I were doing it together, many years ago. There's always something new, and it always feels like it's in the early innings. And I feel like for my entire life and my entire investment career, it's going to be in the early innings of something exciting in software and technology. And it's a great place to be. When I think back on the past 30 years, I feel like the two biggest drivers of sort of the value creation that's occurred in the U.S. where globalization and technology productivity. Globalization, unfortunately, feels like it's sort of going, stalled or going backwards right now due to a lot of the geopolitical issues. And I think technology innovation is going to continue to drive productivity, and I'm bullish on the world because of that.
So thinking 2022, just to wrap up, thumbs up, thumbs down, or thumbs down for M&A?
It's going to be less than last year, but it's still going to be, there's going to be a decent amount.
Laura?
Yeah, thumbs up. I think that it will be different than last year, more private equity, less strategic, but still keeping us busy.
Yeah, I agree. I think growth matters, no matter, it's certainly a different environment, but I think companies need to grow and they recognize the benefits of growing inorganically, and they'll continue.
Thank you. Well, that's a wrap up. We've run out of time. I want to thank Laurence, Laura, and Arlen, and for our audience. Thank you, everyone.